Get my dollar trade playbook to learn how to position, profit, and protect during a dollar devaluation. Scan this QR code or click on the link in the description. Hey, greetings, and thank you for joining us for this macro to micro options power hour. I'm Samantha LaDuc, founder of LaDucTrading.com, joined by Hans Albrecht, our options mentor, analyst, educator, trader extraordinaire. And we're going to do an Ask Us Anything type of format after we go over a little bit of the highlights, lowlights, however you want to look at it, as it relates to the macro backdrop. Some earnings season obviously is in full view, but we have much more kind of interesting backdrop as it relates to employment now and how Trump is going to stack the Fed as it relates to some recent announcements and news. So we're very much focused on that. I am anyway. And then we've got productivity coming out, which is usually a bond mover tomorrow morning after the non-farm payrolls on Friday of last week. It was a big deal. All right. So last time that we were talking on Wednesday, Hans, if you remember, was like, I'm lightening up. He's got that trader's feel from doing this a few decades. And I had literally just posted on Tuesday morning, do not wait to hedge. 5 words in my teacher's voice. But it was very specific for short duration traders. So I was not talking about the trend reversal. I was not talking about the swing time frame that can last several more weeks to months because my growth rotation is still in play. So this was very much a shake and bake warning, and we got it. And in fact, I talked about that Wednesday after the Powell pushback from FOMC. We were doing this live. And I said, don't be surprised if non-farm payrolls comes in weak, whether by design or by default, to give Trump more ammunition to scold Powell to cut rates. And sure enough, wow, did they come in with major revisions, so much so that the director of BLS was fired on the spot. Now, I wrote a big post about this. In fact, I posted this yesterday for LaDuc Trading clients, but I also made it available on Substack. And that's a mini-me product. It is nowhere near the full trading desk of LaDuc Trading, where we have 10 contributors, and we're talking tons of education, analysis, trades, trading room, courses, everything. No. This is just my mini-me project. But if you want to see that, SamanthaLaDuc.com, you'll get full view because I wanted to make that available to kind of talk about that BLS data because I believe it is actually showing us good signs of recession risk getting pulled forward. So now that makes it more imperative to see how Trump is going to do kind of an end run, if you will, as it relates to dominance over the Fed. Everything as it relates to Fed monetary policy right now is under fiscal dominance. We've talked about that from a macro standpoint, but I wanted to just kind of put that out there and give you an opportunity to look at my employment view in all of its full glory. And basically, that's my focus of yesterday, was to write about how employment trends right now are moving lower. And we hadn't really had any solid data. We'd had some soft data. We had, of course, ISM, manufacturing and services, come in contraction territory for output, also contraction for employment with very strong prices. We've seen that type of trend within segments of the economy. But for the actual recorded job hit, this is not an estimate. This is actual in the field numbers as it relates to job growth or contraction. The BLS did a major revision, and that shows we have weakness underneath the surface. So that's what I wanted to just point you to if you're interested. And then, Hans, what are you looking at? Because that's basically my purview right now is employment, which is falling, prices, which are rising, CPI next week, productivity tomorrow, economic data, macro, always as it relates to dollar yields and oil. But right now, those are still staccato, meaning they're not really big headwinds. We got our sharp shake and bake, and then we kind of relax. We're in that pause area, which I warned about July 31st and August 15th. So now we kind of go pause until the August 15th when I think we'll get some more volatility. What do you see? And share with us what you got.
I think, again, it's another example. And that was kind of the big question was we got the sell off. We got that sort of ridiculous. We showed the sharp with the put selling and how unnatural that was. And it played out sooner rather than later, and as it should have. And the big question was going to be, well, does this finally have some legs to the downside? Can we see a little bit of a durable few days down, which I thought we could. We had a good chance because sometimes those, as you know, Samantha, parabolas don't just end and then get reinvigorated after a day. They kind of take a little bit of time for that air to come come out of the balloon a little bit, and it didn't. And I think that's quite a positive for the market in terms of, I have maintained that I think there's going to be a little bit of a pause, maybe for a summer break. Everyone goes off to the Hamptons and the beach and things like that. And then eventually we have a further melt up. Maybe that just gets compressed again. I'm not sure at this point, but I remember saying earlier in the week, I said, if we get a couple of strong days after that big, fairly reasonable sell-off, what we finally got out of the market, I think that's a very big positive again. And I think people are just kind of going back to what looks to me more and more. I mean, I've been talking about the AI thing, but it looks to be more and more unknown kind of future for the market. And what I mean by that is there was all this concern about spending on AI and all this CAPEX and everything. And we saw from the hyperscalers that it's not so much a cost, it's looking like it could be a profit engine. So I think that's how the market may look at this as, well, you're spending another 50 or 60 billion or 100 billion, but it's turning into actual money for Microsoft, actual money for Meta and friends. So I think there's this idea that it's not so much a negative, it may actually be a positive in a world where if you're not involved in AI, and I think this is going to filter down into the rest of the economy, if you're not involved, you may be facing a new reality of having existential risk at some point if you're just not involved and not getting on this train. So I think it's going to be, if you're spending money on AI, it's actually quite a positive, and people are going to want to hear that. They're going to say that you have a plan. You are going to spend some money on AI, whatever that means. And that, of course, is going to just play into the hands of the Nvidias and, of course, the hyperscalers and the cloud providers. I mean, they hammered Amazon, which I was like, okay, fine. So they didn't do as well as Azure, but I mean, that's not what they're about. That's not what the Amazon cloud layer is about. They're about basically the foundation of what happens in the world. So they're in a fantastic place. So I think it's interesting. Beyond that, I've been playing the sort of valuation vertigo, as we called it, the valuation vertigo, which is Palantir being the absolute poster child for valuation really not mattering as much anymore when the story is strong. So I think what we're seeing emerge here, and it makes sense because this AI inference phase is much bigger than anybody can imagine. And so I think we're starting to see some evidence of companies starting to really do a new thing. I mean, Palantir has been around for a while, but I think what they're doing is they're reinventing, they're almost creating a new category and leading it in terms of what they do for companies, in terms of coming in and making sense of data and making sense of inference and making sense of things in the way that we're talking about that companies are going to want to be a part of. And so it's outlandishly expensive. I think they have a run rate of $4 billion for this year. The company is worth Salesforce and ServiceNow together. It's worth the market cap of those companies together. And those companies have like 20 times the revenue. So there's absolutely no question that it is it's over its skis a little bit, but this is what's happening out there. So I talked about this melt up, this Looney Tunes market, because I've seen it before. I saw it in 98, 99, 2000, etc. It can get stupid and squirrely and nuts. And we are going to see that, I think, come the fall. We're going to continue to see those things because there's just this amazing excitement about the new version of the printing press and running water and electricity. And here we go. We have to build it out. So I think it's going to be incredible. I think the PMI, I think manufacturing is actually going to probably have some chance to recover at some point because of this amazing infrastructure build out. Not that everybody's involved in those kinds of jobs, but I think there's going to be this sort of full blown kind of infrastructure boom. So I know I'm kind of going on and on, but beyond all this, I think the market is looking at a heck of a lot of positives and they're overpowering the negatives at this point. I know that wasn't a very good jobs number and I am concerned about jobs, but it is focusing on those productivity gains and the build out, and there's a shortage of all this stuff. So I think there are things to be positive about. We just don't know how that's going to play out. And to my point earlier, which was this is an unknown market. I think we haven't faced a reality in the economy, in stock markets for a long time where we kind of don't know how things are going to play out. We don't know how AI is going to play out in industries and companies, and people are going to surprise to the upside and maybe surprise to the downside too. So it's going to be just this sort of interesting environment where I don't know, maybe valuations aren't that high. Maybe they are for some areas. Maybe they aren't for some areas. So I think there's a lot of kind of uncertainty around that. Analysts are going to have their work cut out for them, aren't they? I mean, they're not going to know where to really hang their hats in a lot of cases. And I think at the moment, the market is saying, we think it's a positive because we're going to have these untold benefits from AI. Let's see how that plays out.
So I wanted to share how outsized this is. And if I share the wrong screen, let me know. Last week, my apologies. I was sharing a conversation in DM instead of the GDP numbers that I thought I was sharing. So you know about concentration risk. The 7 largest US stocks reached a combined $20 trillion in market value, an unprecedented 37% of the S&P 500. That's 55% larger than the index at its its 2000 and 2007 peaks. It matches where the first index traded in April of 2017 and larger than the March 2020 COVID low. So we know all about this huge concentration risk. And you and I had talked about this super peak valuation, remember? So the super peak valuation that we talked about either last week or the week before, I'm not quite sure. It was a data trick compilation, and I showed you a big old chart of where we're going based on this 2026 forward earnings of $302 a share. Remember that? Right now, beyond super peak, this is where we're at. We're literally trading for 33.7 times future earnings. The 7 have pushed the index PE dangerously to over 27 times now. Yardeni has a little bit of a disagreement on this, and that's why I wanted to bring it in. But this is why we're talking about it, is because this CAPEX spending especially is what's really pushing the needle, and they're consuming a huge portion of cash earned in operations. So that's why an AMD didn't do so well, because free cash flow is falling. Meta was down 50% year over year in free cash flow. Didn't hit their stock, but in AMD, it most definitely did. Well, Yardeni came out with this. I happened to just catch that today in my travels. And we're talking about S&P 500 annual 2026 EPS, for those who are into it, is $301. So we just talked about this 302 level as it relates to when Google had their earnings and such. I'm like, oh my God, we're getting closer and closer. So we could still move into that level, is what I'm trying to say. So in support of your argument that it's AI, crypto, blockchain, and nothing else or whatever, that we could still move into these highfalutin valuations, it may not be done yet. Super peak valuation at 302 is what Data Trek was talking about. So that's all fine, but we can't, I don't think anyway, ignore the risks that can absolutely come in to upset that apple cart. So while we're looking at a trend time frame, I'm kind of a little bit more specific. I give a lot more kind of aura of volatility around the movements, and the market hasn't done anything wrong. And it still has my top 10 list of why it's still bullish. And one of those things has actually petered out quite a bit, which is mechanical buying. CTAs are getting exhausted. Vol control funds are getting exhausted. Corporate buybacks were massive in July. They swamped prior years before even 2006. So we got a lot of support, actually, surprisingly, in July from those buybacks. That can't continue at that same rate. Point is, we had and dealers, they're kind of a little tired too. So we have some of that in pause mode. So that makes the volatility on the intraday, or let's just say for the next few weeks, especially during August and seasonally weak months of August, September, and October, more event filled. It can move about a lot more. So before we had this ballast, this absolute ballast of mechanical buying. I have talked about it weeks and weeks and weeks. We have both shown the charts from the CTAs to the vol control to the dealer. Now we got dangerously close, very dangerously close to a gamma flip level. We popped down below it, went from Thursday peak into that Friday morning. 62.28 was the level that I gave clients literally Friday morning at 10 o'clock and said, it's done going down for now. VIX was then sold. Markets popped right back up to where we gapped down Monday. And so everything looks fine again. So that's the reflexive nature of this short duration market that we're in. But to try and get it moving into that super peak valuation, we're going to need more good news. And right now, a lot of it has been spent. So the fiscal all gas, no brakes. Well, if we have a shutdown in October, which right now is not out of, it's a wild card, but not so much. This is actually a strategic move potentially for Trump to come in and get power of the purse. Things are a mess right now in the Senate, and the Epstein drama is distracting. But the point is they're using everything they possibly can to create this chaos around appointments and the appropriations of the money that was passed in the OBBA, et cetera, et cetera. So we actually have, that's a break. We have Fed Powell, this is another area, who says we don't need to cut right now, but the market is saying, but look, employment's starting to worry us and you need to cut. In fact, they priced in cuts into the end of the year. So September has an 88% chance of a 25 basis point cut. By the way, they already put that in. Immediately, the 2-year yield dumped 25 basis points on Friday with the NFP job growth revisions. So immediately they repriced the market at the 2-year, which is saying Fed's going to cut in September. That's already a fait accompli. Now there are whispers it's going to be 1 full point, not a quarter by the end of the year. So the point is the market is weighing constantly the AI narrative with the earnings this free cash flow hit that is happening at the top of the food chain because of CAPEX. We've got fiscal, but we have a little bit of a hitch in the giddy long around how it's all going to be distributed, and it has not been resolved yet. And shutdown risks, believe it or not, will start to grow louder as we get into September. People are still on the beach and they don't expect the market to fall apart during earnings. And earnings really haven't surprised. They've beat the low bar. So we're looking now at what's going on with this drama, not just employment underneath the surface, which I've written about in length, so I'm not going to dig into that. But the point is, they've now got the drama of Friday. Trump is going to come and announce, as early as Friday, he said, who he will have as the new appointed Fed governor that he will want to get approved, I should say, to replace Kugler. So a voting member who has resigned same day as he fired the BLS director as a way to stack the Fed bench of loyalists to get rates cut in the future. But what good is that going to do if prices are rising, which they are, and employment is getting shed, which it is? So rate cuts are not going to save us. And more importantly, and then I'll stop my rant, this is a new regime change. If they bring in a Judy Shelton, if they bring in a Kevin Hassett, these two characters are, of course, Trump loyalists, but they're major regime change. This is not coordinated policy intervention like we're used to between.
How does the dollar react to that, Samantha? How will the dollar react to that?
Lower, which is the one ballast that helps equities stay afloat. So if we have a Fed overhaul, which is what Trump is trying to do, Bessent is trying to do, a Judy Shelton would absolutely advocate for. She wants the gold standard again. I mean, we're talking not what we're used to, which is QE, which is policy intervention of any kind to backstop a growth shock, sovereign debt crisis, dollar spike or yield spike. They come in with intervention. So if we do have a new Fed overhaul, which absolutely will happen after Powell leaves, but maybe even before, then how's the bond market going to react? So these are some of the unknowns that are more important to me than whether AI is going to produce revenue next year or in 5 years.
He probably should be cutting rates. But again, like I said last week, I'm not sure how much it's going to help. You're right. A lot of the money is being made by MAG, and that's been the case for a very long time. But the hope is that productivity and lower rates hope to give a little boost to the rest of the economy. Companies can sort of do with 10 people what they used to have to do with 25 people. Sure, that has an employment impact, but there's sort of hope that that's the kind of thing that infuses the economy on top of all the infrastructure spend and all this sort of having to get us to this destination of the world being retrofitted and outfitted and everything with all the required equipment, et cetera. So the cloud, the data, the GPU game, I think that's a pretty good business to be in for quite a while longer. But we do have some things. You mentioned the vol targeting, not much left to buy there. In fact, there's some scenarios where they might end up being slight sellers. And retail, which has really sort of taught institutional hedge funds quite a lesson, which is retail should be proud. They've been net buyers, 14 consecutive weeks or something like that. So really, really big retail buying. And finally, what we saw is some of the capitulation over the last few weeks from the sort of institutional community starting to push into the market. And I think they're pushing in a way that is long the market, but with lots of downside protection. So we're seeing skew measures really pick up. That downside skew is really, really pumping up to sort of 100th percentile for that 3-month skew, which is looking at the 25 delta put versus the 25 delta call. So that gives you this idea of how does the curve, everyone kind of focuses on that at the money. So when someone says, oh, Microsoft trades at a 25 implied volatility, that doesn't really give you the out of the monies. Sometimes the out of the monies give you that extra little bit of intelligence, of nuance that you want, because it kind of gives you an idea. The at the money sort of tells you, well, this is what the market feels. Doesn't feel like anything's going to happen. But what if we're wrong? The skew plays the what if we're wrong card. And so right now we're seeing that downside skew very, very steep again. So it feels like people are getting into the market either with upside calls or stock or maybe stock replacement type call strategies, which I'm a huge fan of. By the way, I've been doing tons and tons of those over the last few months as a way to take part in some of these moves, but just have a little bit less skin in the game. Even as bullish as I've been, I find that's a very capital efficient way to do it. But they're doing this with protection. So what happens is the upside is actually kind of getting cheap again. So if we're going to continue to get that melt up, upside calls are starting to look a little bit interesting again. But having said that, I think you're right. I think we've sort of had this exhaustive move that is kind of typical of summer. Like, so if everybody's looking at this going, oh, we just moved up 800 points in a straight line, well, we're going to do another 800 points now. now. It probably isn't going to be nice and clean and tidy like that. It'll probably be like, wow, like a day like today, oh, we're breaking out again. And then we'll maybe get a pullback, and it'll be just maybe a little bit messy for a month and a half, exhaust people a little bit, and then back to the races, I think. But they certainly aren't shy about getting into some names like Reddit, which I've really liked, $120 not long ago. Now it's $212. So they're really reevaluating how they think about certain companies. Is this company going to be able to survive and even thrive in this new world? And so maybe for MAG, it's going to be, well, what have you done for me lately? The usual sort of stuff, which is they do fine generally because they hold all the cards in terms of data and cloud and all these ecosystems that they have. But the rest of the economy is kind of like, are you doing it right? Are you on board? So it's going to be a very, very interesting time.
I'm going to show a chart that I haven't for a little bit, but you know how I am a little bit focused on sector rotation. I have a very strong belief that in lieu of sector rotation, there will be volatility. So I tend to follow the dollar and yields, especially a little bit of gold. Right now, it's not very exciting to trade because it's range bound at that 65 monthly support level. But I still see this as a continuation lower. I've been on that early since April of last year, June of last year. So this is all working. But when it comes to the migration of following momentum stocks over value stocks or interest rate sensitive, because you're a yield bear, I'm a yield bull. Big picture, I think it's going to stay pretty firm even as oil falls and even as dollar falls. So we've talked about our differences on this particular one, but as it relates to this one chart, this is a great sector rotation tell for those who are wanting to kind of follow what happens with, and I should probably take a picture of it. So this growth value rotation, I've been talking about this, anyone who's been here for a while. This was July 19th, 2024, before the yen carry trade unwind, and it was a whopper. And then we went into the August 5th low. We hit another September 11th low before Nvidia came out and did their dog and pony show on CNBC, et cetera, et cetera. Up here, hopefully you can see it a little bit, but this was the Trump bump, very much the election move that formed also in this growth value rotation, a head and shoulders formation. So I was already bearish in December, and specifically before the 3% drawdown on December 18th, because I saw the selling come in under the surface starting on December 2nd. That's how I do this. Anyway, long story short, you know what happened on April 9th. We got the intervention. This is down here, and that came in, and basically the rest as we know it is policy intervention, which was Trump, and this growth move. Remember, this is a growth scare. This is a growth scare. Tariffs, by the way. This is not just Trump coming in and the bump turns into thump. It's also Trump tariffs, and no longer the dollar is exceptional because it's part of the policy to devalue the dollar in order to hold assets higher and make an advantage for U.S. exporters and to make it harder for U.S. importers, and also tariffs on U.S. importers. It's like a triple whammy, and consumers spend less on U.S. imports because it's more expensive. So anyway, the point is this is now still in growth rotation. And one of the reasons why I can't be trend short or swing short, but I've also warned once we get into this overbought level, I'm going to be looking for a reversal. So I am not talking about last week when I said, do not forget to hedge. This is a short duration call, especially with NFP. Just, it all worked. But the point is, once this rotation starts to form a pattern and roll over, we have a durable swing short that lasts several weeks. And it can last several months. This one was only a month before it hit oversold August 5th. You were running the trading room. I was on vacation. VIX hit 65. So we're in this upper, it's not rarefied air, but it's definitely extended, but it has formed no reversal pattern. So I'm still going to be focused on that type of interruption of the bullish growth rotation. Now, what are some things that could interrupt that bullish rotation? Well, productivity gains. You talked about productivity gains as the panacea for AI. It's too early, even though we've kind of had it for a little bit. The point is, it's too early to impact the productivity gains, which are also lagging. We had a negative 1.5% productivity result for Q1. So if you annualize that, it's not looking really good. So we need Q2 to see what we got there. Is there any improvement? Bonds typically move relative to CPI, productivity, and wage inflation. So those are the three big yield movers. So if you're thinking about how to trade those events, you care about productivity. It only comes out 4 times a year, and it matters. Believe believe it or not, to bondholders. And right now we have a very illiquid system between July 31st and August 15th, which is what I profiled for clients. It's very illiquid, which means we're going to chop all over the place. It's not a trend. It's not a time to position in the market higher or lower, big picture, because we're going to chop all over the place. But this is another thing that could interrupt the growth rotation. Consumer price index. Right now, everyone is still very excited about the falling rate of change in CPI. But this is what it looks big picture. You got CPI that is definitely since its peak, which is how Wall Street measures consumer price index. And by the way, 30% of its components are estimated. So it's not like BLS, which is actually in the field job reports from small, medium, and large companies. So this is an estimate with 33%. So we're kind of like, oh, no, we know those numbers can be fibbed. But the point is, this is starting to rise up. The big reason I saw that CPI would be falling and it would also be supportive for markets is because shelter makes up a huge component of the weighting of the CPI metric. And since everybody looks at CPI and says, oh, we're in the twos, we're fine, there's no inflation, Fed should cut. They're not looking at inflation, the compounding inflation that we have for real. They're just looking at the CPI rate of change, which is what this is. And it's starting to rise up. So this is another one that could absolutely interrupt the bullish momentum and introduce a growth scare. Yes, we always have employment and real earnings, and producer price index is pretty much rising. We know prices are going up. That's part of that inflationary impulse from tariffs. And by the way, they are going up and they are inflationary. So the government coffers are going to make more money and the rest of America is not. It's a regressive tax. So anyway, we do have a little bit this week just to kind of put it on your radar. If you're looking for more shake and bake, we definitely have lots of it. But I would say for the most part, the biggest threat that we have right now is the health of the employment market. And even if AI contributed, I've heard 0.7% of GDP all the way to 6% of GDP growth. I've heard that AI has contributed that positive impact to growth. But consumer spending is still 70% of GDP. So what happens in employment is going to affect the growth trajectory. And right now, I think eyes need to be really focused on that. And we haven't seen any tick higher in jobless claims for actually a few years. But every Thursday, I look for jobless claims. And last Friday with the non-farm revision, if we had not had the AI contribution also to the employment picture, one of the analysts that I cited said unemployment would have been 4.9%. That was it. If not for collapsing labor participation since April, unemployment would have climbed to 4.9% today instead of 4.25%. So we do have collapsing labor force participation. So we only had 4.25%. But the point is, this buffer that we had in the past has been removed. So there are going to be, I think, reasons to be focused now on labor market health. And that is also another thing that can interrupt the bullish flows and create a growth scare. So be on the lookout for that.
It could. I mean, if Powell gets on board, then that will be considered one more layer of, okay, things are weakening. Maybe CPI. I don't know. They use the shelter component isn't even real. Like they should be using Zillow, I don't know, the rent index. Those things are much more real time, much more reflective of where pricing is. So I think if you sort of back that out, it's maybe not as bad, Samantha. I'm not sure what it exactly is, but it sort of overstates that aspect. So once people realize that inflation isn't really that much, I mean, except outside of rare earths and some of the, I mean, I think there are backlogs. So companies are saying there are backlogs. What was the one company, the power company, said they have contracts out to the next 5-10 years? Like they are literally, there are parts of the economy related to this AI build out that are just gangbusters. And that's going to sort of juxtapose with other areas that are going to be suffering. So it's going to be a very weird world.
Siemens, that's something that I posted. Yeah, Siemens has 3 years of backlog, but as it relates to shelter, it's a lagging component. So we're talking about different things. The composition of the CPI and shelter is one part of that, X food and energy. The point is we still have an inflationary backdrop and a slowing economic backdrop and a rising unemployment backdrop on a macro standpoint, juxtaposed against the AI narrative of more CAPEX, more productivity in the future that has been pulled forward. So all I'm saying is we can still rise up. My growth ratio has not rolled over. We have saw selling for 1 week Really, literally Monday through Friday, and then boom, it was short-term recovered, although under the surface, breadth is still needing to repair, which is why I'm cautioning the next few weeks, especially after August 15th. And then, of course, we've got the seasonality of September, October market weakness. So that's it. I just want to kind of like highlight, I do the macro risk event triggers. But I am also not blind to the fact that the trend is still strong. Even if the AMD numbers were not on the cash flow side, they still have revenue growth. They're still, in comparison to Nvidia, oversold, relatively speaking. I know that the bull narrative, and this has been a fabulous trade long that I recommended from this 400-week, gorgeous. Technically, it's been gorgeous. Post earnings, it was a really nice short, though, at the open, if truth be told. So the point is, you can play lots and lots of time frames. Just hopefully, if folks are coming in here, they're getting a little bit of your very, very bullish take, but you're trading actively in and out. My macro event concern to be aware of. That's it.
I did add some protective positions on that sell-off that we got. Just said, I'm going to start layering these in if we continue down. So those ones are not doing well, and that's fine. And some member asked me, well, what are you going to do with those protective put positions? I said, well, they're doing their thing, and I'm not going to do anything with them. In fact, I'm probably going to add to them. I'm leaning more towards if something gets ugly and something breaks big time, then I'm going to want an oversized downside hedge. So I've sort of gone through this with some students, and let's say your budget is $10,000 for your put protection, your protective layer. Instead of buying one put for that to protect your 100 shares of the SPY, you can go move down to a further out strike. We've sort of talked about this in the past, but I assume not all the same people are here. You can sort of use the same budget and buy twice as many puts, or even go further out and buy 3 times as many puts. And what that does is, in a catastrophic sell-off, it will end up giving you that boost that you need, and perhaps even protect the whole downside, which one put against 100 shares of stock isn't going to protect the whole downside. It's going to turn that into a long call, basically. You still have some risk there. So there are ways that you can, I'm getting more questions like that actually lately, which is, how do I protect against a black swan?
Yeah, I don't get, because I read about that, just, I forget the firm. Basically, they had these black swan protective puts all the time.
Universa does it. Yeah, Spitznagel.
Last money until 2020 downdraft, and they had a 3,000% return for the year.
And then he's on TV. Look what I made. I made this. Let's not talk about all the money I lost before that. That's kind of how that game works.
Doesn't even come up.
You really look great once every 5 years. You look like a genius. So it's one of those things.
Someone is asking about RSP to SPY. Here is what I think you're referring to. This is part of my stock charts. I look at this every single weekend to find inflection points. And long story short, this is RSP to SPY, and it is a ratio. It's in dark down here. And then this is actual SPX. And you can see that we've had a little bit of a comeback here, very shallow pullback. But RSP, you can't even appreciate how low this is. RSP, which is the equal weight. And I go over this so often. I actually have used this as a timing trigger. You're going to think I'm whacked, but I do not care. It has worked. So not only is this oversold, I'm talking relative equal weight relative to cap weighted, heavy concentration risk. We just started off the hour with that. Now look, this is weird. Just bear with me. This is the one I don't show because everyone's going to go, huh? But this is RSP back in 2008 financial crisis crash. And this is, Trump came in right here, and basically that was it. We have just, in RSP, had a bludgeoning. Had a little big dump back here in 2020. So if you can tell on this big chart, this is where we are for RSP relative to SPY. This is where we were at the COVID lows. This is where we were at the great financial crisis. Isn't that crazy? Now, the reason I say don't call me crazy is if you were to see this, you'd see a little note in here, and it says, ratio crossed below SPX near Trump's election and has stayed below in time as ratio stays at 0.6 is 2006 level. SPX equals SPX 2150. That's 2001.50. The more likely the divergence corrects. So that was my note. What did we hit during the COVID low? 2150. So I was able to literally freakishly, I know, but figure out that we were actually going to go and hit 2006 lows on this COVID correction using this ratio. So when I say I have some weird things, I got some weird things that I use, but my system works.
It does. And you're very patient. You're willing to just put it out there, VIX 1458 or whatever it was. And that's pretty much what we hit.
This is the thing, though. This is reversion tool. So people get really frustrated. Wait a minute. It needs to keep going up or keep going down. No, VIX is just a reversion to the mean. So when you see it falling, and I can do that, it's going to go down to 17, I said. And if it breaks that, then the market's going to get bid again. So the point is, you can also use this as an intraday tool if you know how, but it's not going to be staying at 60 or 65. That's just not how it's designed. You got to use it smartly. Anyway, what are you looking at right now? I kind of went over the macro event risk front and center, especially CPI and the Trump announcement this Friday. We've talked about that ratio growth to value, which is really getting in there. So it's going to start forming some type of reversal pattern soon, which means more shake and bake. And I've got August 15th, which I've also shared. What else? I mean,
yeah, I've been trimming. I mentioned last week, I got rid of a whole bunch of Palantir today, and I got rid of some Reddit. I'm getting rid of a few things. I did have an Amazon put collar that worked out. It came down. I put the collar on right ahead of the earnings, and of course they disappointed based on that cloud growth. And it came in and it got down to 213, 214. I bought back the call side. So I captured about 95% of the call side. So now I have the put spread on for about 50 cents. So that's a kind of a nice way these collars sometimes work out, is that you have a few different pieces to play with here. You have the downside put spread. It's called the put spread collar. And you also have the short call that's financing it. But as the market comes down, you can take off the call side and then just keep the put spread on. Now I kept the put spread on. I probably, as bullish as I am on Amazon, I probably should have taken it off, but I figured, okay, this will be a good lesson. Free put spread, basically. Let's just kind of wait and see how it turns out. If it rallies back, great. So I missed an opportunity to sell out my protection, but mission accomplished. Amazon's going up again. So you kind of have to figure out, and I get that question a lot from folks who are like, when do I sell out my protection? When do I sell my hedges? And I said, well, that really, really depends. If your advisors will have it on and then just accept wherever it lands by expiry or close to expiry. They're not trying to necessarily aggressively or actively trade the hedge. It's just there doing what it does. It's kind of like saying, my roof caught fire. Should I sell out my house insurance? Looks like it's really gone up in value. I'm going to sell some out. No, you might need it a little longer. So it really depends who you are. If you're more active, you're going to want to monetize. If it's VIX, you're really going to want to look at monetizing, because the VIX is a different animal. It's sentiment and not so much a very specific level on the S&P that you can point a finger to. Whereas if you own 5,500 puts, the 5,500 strike puts, you know exactly what those are going to do as the market moves below that strike price. So you kind of have to know who you are, what kind of trader you are. Are you shorter term? Are you long term? Are you just putting on hedges for the sake of, well, they're going to do their job and I'm going to let them, which is kind of how some of the strategies do it. The JPM caller, they're not actively trading any of those positions. They're basically every quarter they roll them. And if there are times where the protection was up massively and they didn't take it off, and then it goes to zero and the market rallies back, but they're not worried about that.
And we're getting a question about, while you're looking, if the rates are cut, dollar drops, but are the rates going to fall is the question, because last time in September 18th, 2024, boom, we got that big BLS revision right before the Fed came in and did a surprise 50 basis point rate cut. This is, again, we had an early August non-farm payrolls for a July revision. It was a massive revision where they had to drop 818,000 jobs from their roster. That resulted in the Fed coming in 2 weeks later with a 50 basis point cut. So when I say employment matters, pay attention to employment, because it dictates Fed policy. And then you've got Fed policy at that point. Rates did not fall. They cut 50 basis points, and we had the next few months yields rise 100 basis points. This is fiscal dominance in full view. This is why rate cuts are not necessarily bearish yields.
Well, and that's the thing. I think if we do get the rate cut, which is it's looking increasingly like we are, which is why I've been positioning in some rate sensitive areas, which are working out. They pulled back just a touch today, but I think that's not a bad place to be. But oftentimes you do get the market sell off when you get to that rate cut. So there's certainly an argument to be made that our bullish follow through can continue up to the point of the rate cut, because if the rate cut is coming because employment is weak, if the rate cut comes because inflation's under control and everything's hunky-dory in the economy, then that's one thing. But if it's because we're starting to see some big cracks in the labor market, it's not something that the market is going to enjoy. So, but oftentimes that rate cut is not exactly a positive. Historically, it's not really a positive, but it's a very big forecast fork in the road, though, isn't it, Samantha? When you get the rate cut for severe economic issues or underlying issues, it's a very different story. But if you get a market where we're not going into any serious contraction and you do start getting rate cuts because perhaps inflation isn't out of control, maybe it isn't coming down quickly, you could really get kind of a roaring 20s scenario of everything starting to align. So that's one way. Now, I wanted to show this because I mentioned this last week as one of my reasons to sort of get very, very cautious, is that I love looking at this indicator, which, sorry, I don't have last week's, but trust me, it looked like this. This is the S&P realized. So this is the blue is realized volatility. That just means actual movement in markets, but very short term, 10-day. So I like to look at the 10-day versus the 1-month option pricing. So this is 10-day movement versus 30-day actual option pricing. So think of that as the VIX, basically. So what happens is things kind of move around. We have relatively normal volatility, and then we occasionally get these periods where everything just dries up. And it happens just like it did recently, where you get into those mid-single digits realized volatility, and it feels like nothing bad can ever happen again. And that was the reason for that put-sharp ratio chart, which showed you that selling puts was almost guaranteed money. I mean, you couldn't lose. And so what happens is option pricing no longer drops. It drops up to a certain point, but it doesn't want to drop anymore. You notice how the VIX doesn't go to 5? That never happened. Occasionally it got into the 9s in the 2017s, but it does not drop below a certain point because it says, I've been around a long time. This isn't my first rodeo. We're going to stay in there. But what happens is everything gets quieter and quieter. What's this gap here? This is volatility risk premium. Technically, this is a very positive time to be selling options because you're getting this big gap between what's the insurance company charging and what's the risk in the market. Well, there's a big gap there. You're Warren Buffett selling up here and there are no claims on your house insurance down here. But the problem is when you see this, as you saw it here again, as you saw it here, as you saw it here, as we saw it last week, you get this big gap. That is always a warning. So if you guys want to watch one thing, it is realized volatility, like a 10 to 20-day measure. And when it gets into the single digits again, meaning below 10, especially down towards 6, that is a warning. It is like, it keeps happening every July because July is such a strong market seasonally and everything gets so quiet and people feel like, well, we can never lose again being long just about everything under the sun. And then you get one day like that. Now, it was a day and that was it. So we'll see if there's still a little bit of damage on some of those charts. So we'll have to see if we recover. I don't think we fully recover yet, but
Lewis is actually asking about the SOXL Leaps trade. Is this one that you put on? Because I'm not familiar with it.
Yes, put on the Leaps trade, a big, like a turbo trade, as I call it, which is sort of selling, risk reversal, basically, finance trade. You know what it is, Samantha, basically upside. And it did really, really great. And then at one point I put out a video showing how I was rolling a portion into an upside call. So I was up $6 or $7 on the original position. And I took the $8, $9 out of it and took the original investment plus a tiny bit more and put it into an upside call spread. So I showed how you could sort of put some money in your jeans and still maintain that upside by buying like a 33.46 call spread. That was a way to kind of reduce your risk significantly. So we've seen it pull back. Well, the SOX, I think diamond hands are pretty good here, but I think it's still a good place. But it's unfortunately for the SOXL, it's based on the SOX. And overall, we've sort of seen a bit of a bifurcated semiconductor index. At this point, it's kind of like AVGO wins and Nvidia wins. Like there are a couple of winners and we've seen a lot of other ones drop the baton or at least not follow through in the way that some of the main horsemen of the semiconductor space have done. So I think it does come back because I think this is just all too big. I mean, I think the build out is going to continue. It's going to continue for the next 4 or 5 years, maybe longer. It's gigantic, but I think that position is a January 2026. So I think on any kind of rally, $2 or $3 rally, you probably want to roll that position into something with a little bit longer lifespan to it.
All right. And I'm getting questions about gold miners, but I don't use RSI. Nope. Not even a little. Nope. Never been my thing. So let me show you what I do use on the gold market. There are a few things. First, macro. Macro is always my backdrop. So when this started to get busy, actually, was November of 2023, Fed pause and Yellen Yahtzee. So Fed, after basically this rate hiking regime, said, okay, we're going to pause now. And the market loved that. And Yellen came out and said, we're not going to issue any longer duration notes and bonds to finance this growing fiscal deficit. We're just going to issue short duration. So long story short, this fiscal excess gas that they were financing, gold responds really well to. So then we had a kind of a consolidation period. Under the surface, there was lots of accumulation. There was macro also coming in. This is my backdrop, first and foremost, not RSI. Coming in saying, okay, guess what? China is hoarding gold. We can see this accumulation going on. Why? Because they're settling outside of the dollar and the petrodollar and using gold for settlement. So long story short, there has to be this macro backdrop. Okay, that's the big picture, but that doesn't really time entries and exits. So I have other tools for that. My intermarket analysis, and I'm just going to show you a few things. This is one where gold silver ratio, my version, came in, and this is to kind of talk about this on a monthly. So I know, big picture, but this is why I'm going to get at why it's so important to me and why you're worried about it being an overbought, and I'm not. So yes and no, meaning it's a trend that is in play, and they have like train, and not just a train that's empty, but all of its cargo hulls are filled, and it's just not going to come to a stop. It's going to need miles to come to a stop. It's got to slow and then come to a stop. It's too fully loaded. So I don't think this is a bad analogy, if a metaphor, if truth be told, but this is the chart that I had, which is a gold silver ratio, and it basically bottomed in, again, as I just said, November 1st, 2022, we had massive central bank intervention, and I'm talking $1.5 trillion according to Matt King of Citibank. And then we had the Silicon Valley backstop of March 2023, and then we had the October low, and then November 1st, right here. November 1st, we got above this trend line. So I'm using trend lines and I'm using a ratio chart, and this was gold. It popped above, came back in, and then this was it. March, everybody knows, in March of 2024, gold took off and has not looked back. Silver took off actually in April. And I also really have other tools for this analysis, but the point is, this is a trend, and then it's on a monthly, because you're talking monthly, it's not RSI, there's no RSI for me. Even though this would come in and kind of digest sideways, it would correct in time, it would break out again, it would come back, shallow pullback. Here's a 10-month EMA breakout. I thought it was going to come back in a little bit. It did not. It keeps going. So are we extended? Yes. Is this a very extended, like this is 2011, 2012 timeframe? Yes, it's extended. But then I look at my bullish percent gold index, which is, because you're asking about miners. And this is another little funky chart, but long story short, we were extremely oversold back in this October, November timeframe of 2023. And again, it just keeps giving. Once this gets and stays above the 80, this is an oscillator, zero. It's not gone below zero since 2015. And it got up to 100 back in August of 2021. Those are the only two times it's hit an extreme. But what it does is it stays above, and it's really bullish. So bullish percent index for gold miners is hot fire flames. This is not in any way, shape, or form falling. And this, by the way, underneath is kind of GDX. You can see this with Bollinger Bands. You can see gold. Silver's a little bit choppier. But the point is, I use different tools than RSI. This one gives me more confidence of when gold is overbought, oversold. The other one for miners, this is one that tells me I have really no problem with this trend, except it's very extended. And then I can go on a daily time frame and look at continuous contract. That's on a daily. I can see this trend. I can see this wedge. I can see that we fell and we've gotten back up into the underside of the wedge. So daily, intermarket analysis, monthly, I'm looking at it all. But ultimately, I look at this. So here is gold miners. Gorgeous scoop pattern. And this is GDX on a weekly. This is a lot of motion on a daily, which is why I pull back in time. And you'll see stochastics, very bid, and no RSI. And it's very bid. And even if it comes back in, it's not bearish. I mean, this is a massive candle back here in April when we had this big reversal in the trade war tariffs. But no time has this come back and closed below the 10-week EMA. You've got a beautiful scoop pattern. You have a fundamental picture of miners are crushing it. And I wrote about this last spring of 2024, where it was like the first inning, maybe the second inning. I quoted actually Rick Rule about that, but I've done enough research on this space, and I've had such good traders who are so much in the weeds with the miners that they know the fundamental picture of each and every one. And generally speaking, oil prices have fallen, and 40% of the operating budget is energy cost for these miners. The underlying has risen. It's the best performing asset this year and last year. So when you have the underlying rising up, you have their biggest cost center falling, you know miners are going to crush it. So yeah, to me, there's nothing bearish about that chart. Nothing. Long story to get to your answer, I don't use RSI. Okay, so Hans, any last comments or things that you're looking at over the next week before we meet again? Because next week we have CPI, which is going to be moving stuff potentially.
Yeah, we got a few things on the way. And then of course, Nvidia, all eyes on Nvidia. I really doubt anyone's going to sell Nvidia into those numbers. I think by all measures, by what every other company is saying, the numbers should be good. But
they're not until the 27th of August. We got tons of
we got a lot of time to get worried about that. But we've had some misses on some other semiconductor stuff.
But be careful on this one, because I do see 172 as a fabulous place to short Nvidia again. Fabulous. This has been my level. So I don't just mean this trend line, but anyway, level by level, we got there, we got above, and we've been kind of staccato the past few weeks. But long story short, we get back inside 172, and that's a reversion to the mean trade. It's not so exciting right now. There's nothing to short, but I would say definitely be careful with that one. Likely it kind of turns into an AMD where it can't possibly maintain these elevated levels right now without a little bit of a sideways pause. So getting from 180 back down to 150 for AMD, it's $30, big deal, but that's a mean reversion trade. And those are fabulous option trades. So anyway, post earnings, you can also wait. You do not have to play before earnings and make a directional bet or deal with even the selling situation if you're not comfortable with advanced options. You can just wait. We shorted this morning when it broke 166. It's fine. You got time. Anyway, I hope you have a great rest of your week. We will be back here next Wednesday, 4 o'clock for Macro to Micro Options Power Hour. Again, I'm Samantha LaDuc. Hans Albrecht. We have some fabulous courses. If you're looking to learn options on the LaDucTrading website, you'll see it. Options courses, options mentoring. And then if you want to interact directly with Hans, join our club membership, EDGE membership, depending on what you're looking for. And I got the live trading room. We've got Chase Live Huddle that runs all day. So we meet clients wherever they are in their journey, beginner, intermediate, advanced, on all time frames, chase, swing, and trend. And look forward to working with you directly. Have a great afternoon, everyone.
See you, folks.
Bye.
Subscribe to LaDucTrading YouTube channel for more macro to micro options power hour and other content.